Hello again from Core Wealth. We'll be covering the month of January 2024. We're well into the new year now, and we'll be having a look at some of our thinking for the rest of this year as well as what happened in January. 2023 was a year when interest rates were pushed up to contain inflation. 2024 looks like we're going to see the reverse of that, with interest rates being dropped. How quickly that happens is a function of how soon inflation actually starts falling. In around the world, geopolitical issues, the Middle East in particular, have seen the oil price go up over 6%. That's not good for inflation. And then also a lot of the shipping now, instead of going through the Suez Canal, is going around the tip of Africa, also adding some cost pressures globally. So that's something we'll have to wait and see for this year. If we have a look at China, we'll chat more about that later in this video. But an area that had good economic growth come out for the full year last year, but was an area that their stock markets really lagged the rest of the world last year. So could we see that changing this year? Then lastly, if we have a look at South Africa, South African equity markets kind of tracked emerging markets, stock markets globally. We also saw in the month of January inflation numbers coming out, quite good and sort of in line with or actually slightly ahead of expectation, but really going in the right direction for what our central bank governor has been talking about. And as we see that get into line, we would expect interest rates to be cut in South Africa as well in 2024. Right, if we have a look at what happened in the markets, we'll start off globally, having a look at US dollar returns around the world. So you can see in the slide that we've had developed markets up slightly for the month. The Japanese equity market's still up very strongly, and you can see over the last year up over 20%, and basically in line with US equity markets. So we've seen quite a strong run in the Chinese equity markets over the last 18 months or so. Then European equities also up slightly, US equities up as well, but the emerging markets and the UK were all markets that were softer during the month, and some of that was on the back of resource companies actually struggling a little bit in terms of return. But if we look longer term, you can see developed markets over the last 5 years now a similar return as to over the last 11, and if you compare that to US inflation over that longer term, you can see that some really good growth above inflation. However, the concerning thing is inflation in the US over the last 3 years at over 5.5% over the last 3 years, when they've been used to inflation below 3%. So that is the concern that we're seeing at the moment. So let's have a look at South Africa. If we have a look at our markets here, you can see equity markets down in line with what was happening in the emerging markets, and a lot of that driven by the resource sector. Listed property markets up strongly, and bond markets also up nicely for the month. So over the longer term, over the last year and longer, we can see listed property over the last 3 years really been the place to have been in South Africa, after some very poor years prior to that. Equity over 3 years and longer, now in double digits over 3 and 5 years. So that's starting to normalize somewhat, making up for some of the poor returns during the Zuma years. The last point I would just make is on our inflation numbers. We can see that they are a lot more stable, all of them around 5 and 6% over all periods, compared to what we saw internationally, US inflation having peaked or spiked over the last 3 years. So something that's a good sign. We prefer to have inflation stable and getting lower, which is what we're seeing in South Africa. But let's start with having a look at our US dollar global strategies. Here you can see done very well against the peer group, hence all the green shading, over the last year. The most aggressive strategy giving you just over 7% return, and the more conservative one just under 5%, so quite happy with that. And then since inception, which is now 7.25 years, again nicely ahead of the peer group, and the more aggressive strategy giving you almost 7% per year over the last 7.25 years, and so very happy with those outcomes. So these next 3 strategies are our global sterling strategies, so for global investors but who look at the world through a sterling lens or a British pound lens. And you can see here This strategy has only been running since October 2021, so just 2.25 years now since inception, ahead of the peer group, hence the green shading. Over the last year, we've underperformed the peers somewhat, and that, funnily enough, was because we don't have a lot of US dollar bonds in our portfolio, which did quite well over the last year. But from a long-term strategy, we're still comfortable with how this portfolio is positioned and the managers that we've got in it. This slide just shows us our South African Rand models. They include international offshore assets, but denominated in Rands. And here you can see a lot of green on the slide. The since inception figures, some of those go back almost 12 years now. So quite happy with the outperformance that we've been generating. The returns over the last year, you can see in absolute terms, weren't that high. The best place to have been was in the bond market and fixed interest type investments, hence the income strategy giving you just over 10%. But if we look at the 3-year number and even the 5-year number on the more aggressive strategies, you're looking at between 5 and 7% real returns above inflation. So that is something that shows that we're generating wealth for clients when those returns are at that level. So we'll have a look now at the Chinese markets, both their economy and their financial markets, and give you some thoughts as to whether there is value there or not. So this first slide shows you what happened in 2023 and in 2022 around the world, different graphs. And you can see different sectors of the world. The Chinese equity market is on the far right, and you can see it was down in both 2022, the orange line, and in 2023, the green line. Compared to the rest of the world, which most of them, other than energy, were down in 2022, markets came off severely, but they made up some of that in 2023. So one of the big things that happened in China was their property market got overvalued and the bottom fell out of it, basically. And this slide just shows you on the left hand side, you can see the blue line is the Chinese stock market in general, and the purple and the gray lines are the property sectors of the Chinese stock market. And you can see that they fell a lot more than the general stock market in China. But some of the sentiment that was linked to that property market has overflowed into the rest of the world's view of China. However, if you have a look at the graph on the right, the property market only made up 4% of the Chinese equity market before this bubble burst. And it's now down to less than 1%. So from a overall market point of view, it's not that there is a lot of property in the equity markets, it's really just the sentiment driving things. If we have a look at what activities are actually happening economically in China, we've got these next two slides. The first one just shows you tourism revenue happening in China and what was spent on some specific holidays. And what you can see is the grey line just showing their national day, and in each of the different calendar years, and May, which is Workers' Day over there, the purple bar. And we can see that in all cases they have lifted up quite dramatically and are well ahead of what was happening in 2019. So just evidence that the Chinese consumer is starting to spend again. This next slide then just has a look at the manufacturing side of the economy as well as the services side. The blue lines being the services side and the greeny colored line being the manufacturing side. And we've compared China, there's two surveys that happened, the NBS and the Kaizen survey, and we've compared them to other big economies around the world, US, Germany and Japan. And you can see that the Chinese Kaizen index comfortably ahead of the rest of the world, and the manufacturing index, although slightly not as high as one would want it, again still ahead of the rest of the economies around the world. Yet China is being valued at less than the stock markets in these other areas of the world. Now China's growth is lower compared to what it was, say, 10 years ago, but it's still a lot healthier than anywhere else in the world. China is the second biggest economy in the world after the US, and last year actually ended up, as you can see in the slide, growing at 5.2% for the year as a whole. So comfortably ahead of any other big economy around the world. but yet there's been concerns that it's not growing fast enough. We're not sure that that's actually a fair evaluation of what is happening there. So we've looked at the levels of the market, we've looked at how the economy is growing and what activity is happening in the economy, but how expensive or cheap are the shares in China? And this is what these slides show us. The graph on the left just shows price earnings ratio. You would have probably heard us talk about this in the past. It's just a way of saying is something cheap or expensive. The lower the ratio, the cheaper it is. And you can see the two gray bars showing the two Chinese indices, the one in mainland China and the other one in Hong Kong. And both of them below 15, and we've compared that to India, which is another big emerging market in the region. Obviously, we've compared it to the US S&P 500, the largest 500 stocks in America, and then the Nikkei 225, which is the Japanese stock market. And we can see that China is a lot cheaper than any of those other stock markets around the world. The other thing to consider is, well, what has happened to earnings in Chinese companies over the last 2 years in this example? And we can see over the last 2 years, Chinese company earnings have dropped by, since 2022, when we saw the markets come off a lot, only 1.9% over the last 2 years. But the stock market itself is down over 30%. Now, some of that could be due to valuations, but we just think that this has probably gone too far. The Chinese stock market, there's good earnings coming through, there's some really good companies there, and yet their stock market is lagging the rest of the world. So we think that could be a sign for years to come that we could see that improving. So some food for thought, I hope. If you've got any questions, please get hold of your advisor or give us a call. We'd love to chat to you. I hope your year has started well, and we look forward to seeing you during the year.